Hello folks. For you folks at home, welcome back. What we did before we started taping today was to take a quiz in here. Why don't you go ahead and switch it over to the Elmo, if you would, so that folks at home can see the quiz we took. This is the quiz we took, everybody at home, and hopefully you can see that. I think a good idea for you folks at home would be just to pause this and take this as if it were a quiz for you folks, and go ahead and push play when you're done and see how you would have done, okay? So go ahead and do that, but let's go ahead and go over that quiz for the folks here that are live. I think I have the answers right here. Okay, take a look at that. I just did that myself real quick. Does that look right, folks? Now, those numbers that are highlighted in yellow are answers, but they're not necessarily in that order that I asked, correct? So make sure you're looking at the right one. But those are very important equations, and I certainly want you to know those. You'll be using those a lot in all your business classes, especially your accounting ones. Okay, so I'm not going to read through them. I think it's pretty self-explanatory. But are there any questions on that quiz? Those were worth 2 points each. So if you got all 5 yellow numbers right, then you got 10. For each one that you got wrong, you missed 2. Okay? All right, and did I put something extra in there that you didn't need? Yeah, what did I put? Withdrawals and accumulated depreciation. Okay, yeah, I put some things that you didn't need in there. I want you to know the equations that you need to know and have confidence in them, okay? Just because you see something extra, don't throw it in there, all right? Because in real life, you'll see other things besides, you know, the given information. So I want you to be able to discern what you need and what you don't need, okay? All right, any questions on that? If not, let's switch over to the PowerPoints. Just a quick little review on some of these slides. We're talking about merchandising operations, which is the same thing as retailers, right? These companies do not manufacture the items they sell, but they purchase them from manufacturers and then they sell them to the end user or to the user. What is the main thing that merchandisers provide? Convenience, right? They provide convenience, okay? We had talked, going over to the slides, we had talked up until, from chapters 1 through 4, we were mainly talking about service organizations that sell time. Now we're talking about merchandisers. And there's that equation that we had on the quiz. They sell products to earn revenues. We gave examples of Walmart, or grocery stores, or Best Buy, or Kohl's. We talked about the cycle, right? You have money, you purchase inventory, you sell it, either on credit or for cash. Eventually you get more cash and you can purchase more inventory to sell, correct? Now, coming off of that, to me, we talked about how there's 2 main roles of a merchandiser. They do a lot of purchasing for manufacturers, right? And then, of course, they sell it to customers, okay? So there's the purchase cycle, and then there's the sales cycle. Correct? What we're going to talk about today is the purchase cycle. We're not selling to customers. We'll talk about that next time. What we're doing now is envision yourself as the retailer, and you are purchasing these different products from manufacturers. So like if you're Best Buy, you're purchasing dishwashers from Whirlpool, and you're purchasing televisions from Sony, okay? You're purchasing computer monitors from HP or whatever, okay? So we're on the purchase cycle today, all right? We talked about the very important inventory flow equation. That was also on your quiz, okay? Now let's start talking about some journal entries from the perspective of the retailer on the purchase side, okay? Let's say on June 20, Jason Inc. purchased $14,000 of merchandise inventory and they paid cash, okay? Well, there you go, right there. That's not too hard, is it? Now, merchandise inventory is a new account, okay? And it is a current asset. And merchandise inventory is different from like office supplies or something like that. Merchandise inventory are items that we have purchased that we will resell to customers, hopefully. Okay? So merchandise inventory is an asset, it's a current asset. And everything that we purchase that will be sold to customers goes into merchandise inventory. Now, of course, there might be a lot of different, subgroupings in our detail, but it all goes in merchandise inventory. Kara?
Is it always a debit balance account?
Merchandise inventory is a current asset and it is a debit balance account. Yes, as all assets are. Okay? All right. Let's talk about some different types of terminology in this account or in this chapter. And some of these are similar, but they're different. So I want to make sure you're paying attention. There's one thing called a trade discount. And this is used by manufacturers to offer better prices if you purchase in large quantities. Okay? Let's look at an example. Matrix Inc. offers a 30% trade discount on orders of 1,000 units or more of their popular product racer. Each racer has a list price of $5.25. Okay? So let's say that they sell 1,000 to us as the retailer. Well, 1,000 times the list price of $5.25. If they didn't offer any discount at all, we would have to pay this $52.50, right? However, that is at the amount, you have to purchase 1,000 or more to get that 30% discount, right? So we can take 30% of $5,250, subtract it, and we only have an invoice price of $36.75. You with me? And this isn't a concept that's too foreign to us. There are things that if you purchase in larger quantity, you get a cheaper price. Can you think of anything like that in real life? If you purchase in a larger quantity, you get a cheaper price? Huh? Yeah, I mean, sometimes Sam's Club kind of works that way, right?
Isn't that why Walmart's so cheap? Because they buy so much of something?
Well, yeah, that's a little different concept, but Sam's Club is probably if you're willing to buy 12 things of toothpaste, which will last you a while, then your unit price is probably cheaper than if you just bought one, right? Okay, so that is what a trade discount is offered offered as an incentive to purchase in greater quantities. Okay, all right. And a lot of times manufacturers can do this because a lot of times some of the cost or effort to process an order of 1,000 units is not a lot different than 5 units, right? You see what I'm saying? As far as the paperwork and all the shipping stuff they have to do. A lot of times it's the same amount of cost, so they certainly would rather sell one order, in this example on the screen, they'd rather sell one order of 1,000 than 10 orders of 100 that come in during, the year. Does that make sense? Okay? All right, let's go to the next thing. Let's take a look at an invoice, and you guys have seen invoices before, right? This is not a new deal for you. Let's look at some of the things on this invoice. Now, number 1 is the seller. That's who's selling it. And number 3 is who it's sold to, okay? Up number 2 is the invoice date, and a lot of times there's an invoice number on there, okay? Number 5 is the credit terms. We're going to talk about that in a minute. Let's not worry about that now. Now, number 7 is the goods that were sold, and it looks like what we purchased as a retailer here was something called a 250 backup system, and that is item number AC417, okay? How many did we purchase? We purchased 500 of them. What was the price per 250 backup system? It was $54. So the invoice amount is $27,000, okay? Now, of course, the difference between an invoice for a retailer is Versus you, and the invoice you see is you're probably not going to purchase 500 backup systems, are you? You're going to probably purchase one for yourself, and that's it. But think about the quantity that these retailers purchase in. Pretty large, isn't it? Okay. Now let's talk about what the heck is this terms two. That looks like two fractions. I don't know what that is. Okay, let's talk about that. What does that mean, shipping terms of 210 in 30? Well, what that means is if you pay within 10 days, you can knock 2% of the price off. But if you choose not to do that, you owe the full amount in 30 days. Okay? So, if you pay by day 10, or earlier, day 1, 2, 3, 4, 5, 6, 7, 8, or 9, or 10, you can knock off 2% of the invoice price. But if you choose not to do that, you owe the full amount in 30 days. You with me?
That's on top of the discount you're already getting, right?
This is off, yeah, this is on top of if there's a trade discount, Matt. This is and I'm glad you pointed that out. A purchase discount is as an incentive to pay early. A trade discount is to buy in large quantities. Make sense? Now, this isn't always 210 net 30, okay? You could have, going to the Elmo, you could have, 310 in 30, which would mean you get 3% off if you pay within 10 days. Otherwise, the full amount is due within 30 days. Or you could have 115 in 60. You get 1% off if you pay within 15 days, but the full amount is due within 60. Or sometimes you'll see something like this, 210 in,
Can't see it.
oops, thank you, 210 in EOM. Do you know what EOM stands for? End of month. So this would mean if you pay within 10 days, you can knock off 2%. Otherwise, you owe the full amount by the end of the month. So there's different ways that you can say that. But in this particular example, it was 210 in 30. Okay? Now, how does this work out? Well, let's look at an example. On May the 7th, Jason Inc. purchased $27,000 of merchandise inventory, this time on account. Not with cash, but on account. And the credit terms are 210 in 30. So when we record this, we debit merchandise inventory, increasing that current asset, and we credit or increase our accounts payable for $27,000. All right? Now, that was on May 7th, right? And the terms here, let me get my pointer out. That was on May 7th. And our terms are 210 in 30. So what day do we have to pay by to be able to enjoy that 10% discount? May 17th, right? If we pay May 17th or earlier, we don't have to give them $27,000. We only have to give them, we'll figure out how much we give them, but it's less than that. Well, we pay them on May 15th, so is that within the date? Is that within the discount date or the discount period? Yes, it is. So we do not have to give them $27,000. We only have to give them 98% of $27,000, which is the 100% minus the 2% discount. So I take 98% times $27,000, and that's how much cash we have to pay. We have to give them $26,460. Now, we debit accounts payable. Don't make the mistake of debiting accounts payable for $26,460. Because in our original entry, we credited or increased that liability for $27,000. If you mistakenly just debit it for $26,460, it's going to imply that you still owe money, right? So accounts payable is debited for the full $27,000. It's satisfied. It's taken care of, even though we only gave them $26,460. Well, how do you complete this journal entry? You credit merchandise inventory for $540. Now, sometimes that seems odd to people, okay? Sometimes that seems odd to people, but I'll show you why we do that in a second. Okay, any questions on how we came up with these numbers? Let's talk about why that merchandise inventory is credited for 540. Okay. Well, if you go back to the original journal entry, we debited, we debited inventory on 5/7 for $27,000, right? On our original journal entry date. But in the end, is that what we paid for it? No, it isn't. So, how much did we pay for it in the end? $26,460. So by us crediting it, merchandise inventory for $540, that means that merchandise inventory is going to be recorded on the books at $26,460, which was the true cost of that inventory, correct? So what principle does this follow? Remember the cost principle? Assets should be stated on your balance sheet at what their true cost was, right? And our true cost for this inventory, when it was all said and done, was only $26,460. Thus, it should be on the books at $26,460. Cool? Now, looking back at that accounts payable, you can see, too, that our original credit was to increase AP for $27,000. Even though we only paid $26,460, we debited it, and our balance is zero. We don't owe that manufacturer any more money, do we? Okay? Make sense? All right. Now, I asked you, I believe, I handed you guys something like this, and it said basic purchase journal entries. Okay. Did you get a chance to try to do that? Okay. Did you have success, or were you totally confused?
I wasn't sure about the second one.
Okay. Let's take a look. And actually, what I want to do is, and for you folks at home, of course, as everything is, it's in your under lessons tab on the handouts for chapter 5. This basic purchasing journal entries is in there. But I want to go ahead and do the bottom one first. Okay? Let's go ahead and read that. Okay, on September 15th, Schneider Company purchased some merchandise inventory from Makarov Inc. with an invoice price of $35,000 and credit terms of 210 net 30. Schneider Company paid Makarov on September 28th. Prepare the journal entries for Schneider Company, the purchaser, on the following dates. Okay, well, on September 15th, we debit merchandise inventory and credit accounts payable for $35,000. Okay. Okay. Now, the terms were 210 net 30, right? We bought it on September 15th. So when did we need to pay by to get that discount?
25th.
The 25th. When did we pay? 28th. Missed the discount, didn't we? So all it is here is, well, you have to pay the full $35,000. You blew it.
I just didn't know if you, since it wasn't 30 days, I didn't know if you had more time to pay all of it. I didn't know if you would
Yeah.
I don't know, pay
What
part
she's
of it.
asking is, why not wait? If you missed the discount, why not wait till the day 30, right?
Yeah.
And actually, that's a good question. Because in businesses, it's like you don't want to pay before you need to, okay? What this company should have done was pay on day 10, not day 5, not day 6, but day 10, taking the discount. If they missed the discount, they might as well have paid on the day 30. Because the longer you can keep the money, the better. It can maybe earn some money in a savings account, and maybe you can sweep it over into a nightly certificate, a deposit, or some sort of interest earning investment, right? But that's a little beyond this. But going to this is the basic journal entry, right? You missed the discount. Okay. Let's take a look at what it is when you've made the discount. And for you folks at home, if you didn't print this out or you didn't understand it, pause it now before we go over the answer and try to do it. Okay. All right, on August 1st, Gilmore Company purchased merchandise from Hendren Inc. with an invoice price of $60,000 and credit terms 210 net 30. Gilmore paid Hendren on August 8th. Prepare journal entries for Gilmore, the purchaser, on the following dates. Okay, on August 1st, we debit merchandise inventory and credit accounts payable for $60,000. Okay. Okay, we had credit terms of 210, net 30. So if we purchased it on August 1st, what date did we need to pay by to get the discount? By the 11th. We paid the 8th. So we got the discount, didn't we? So we do not have to give them cash of $60,000, do we? How much cash do we have to give them? We only have to give them 98% of $60,000, which is the 100% minus the 2% discount. What is 98% of $60,000? $58,800, right? So we only have to give them cash of $58,800. Now we're going to go ahead and decrease the accounts payable for the full amount, correct? Because we're good. We're not giving them any more money. We don't owe them any more money. So that journal entry doesn't balance, right? What do we credit for $1,200? We credit what? Merchandise inventory, so that the merchandise inventory will be recorded on our books at the true cost, which was, in the end, only $58,800. All right?
Does the order of the credits matter?
Nope.
Okay.
No, you could switch these. You're looking at the Elmo. You could switch these in different order as long as they're both credited. Okay? All right, good. I appreciate those of you who read that and tried to do that beforehand. You're probably a little bit better prepared than otherwise. Okay? All right. Any other questions on that? Okay. Let's talk about a few more things in the purchase cycle. Oh, first of all, let's ask ourselves this. If we don't take that discount, is it really that big a deal? Yes. The answer is yes, it's a big deal. It's expensive. And people might say, oh, Krug, it's only an extra 2%. It's not that big a deal. It is a big deal, and let me tell you why. People are used to thinking of, when you think of interest rates and stuff, people are used to thinking of them annually, aren't they? And like if I had a 2% annual rate on my mortgage or my auto loan, man, that'd be awesome, wouldn't it? Okay? However, you have to pay an extra 2% for how many more days? Now you can pay by day 10 and get the discount. But if you don't pay by day 10, when do you have to pay by? Day 30, right? Okay, looking at me here. You can pay on day 10, get the discount, but otherwise you have to pay on day 30. That's just an extra 20 days, correct? So you're in essence paying 2% more for just 20 more days of credit. Now the way that I like to look at this is as follows, going to the Elmo. We said you only get 20 more days, right? Now, how many 20-day periods are there in a year? Well, a year has 365 days, right? So the true annual cost of that's 2% for 20 more days. The true annual cost of that is what? Bang that out there, Sarah.
Hang on.
Don't you love the pressure? Everybody at home's waiting on you. There's millions of people watching this. They're all waiting for you right now.
36.5%.
36.5%. Okay, 36.5%. Is that a good rate? Okay, let's say that Jessica was my controller and I'm the owner of my company. Okay? Let's say Jessica was my controller and I'm the owner. And let's say she said, hey, Dave, I went and secured us a new bank loan. And I said, really, what was the rate that you got? And she says, it's an annual interest rate on our new loan of 36.5%. Would I be happy with her? No. But when we don't take these discounts, essentially, that is exactly what has happened, isn't it? You'd be better off to take the discount and put it on a credit card that charges you 19% per year. Okay? Very important to make these discounts. When I go work with my clients, I often see that they have not made their purchase discounts. Do you know what the most common reason they haven't made them is? Anybody know?
They don't want to pay early?
Just didn't.
No. What's the other one?
I don't know. They just didn't.
Negligence.
It's not because they don't have the money. It's just because, oh, it's so busy, I missed it again. Do you have any classes? Do you have any classes here at school where there's always the same couple of students that are always 4 or 5 minutes late? Okay. Well, they'll probably grow up to be the sort of person that's always 2 or 3 days late on paying their invoices. But it makes a big difference, doesn't it? Because think about how much purchasing Best Buy does in a year. Think if you added an extra 2% times the amount that they purchase. That would be probably tens of millions of dollars. Maybe not that much, but a lot, wouldn't it? Because they purchase probably hundreds of millions a year, don't they? That would be, somebody would get fired, okay, for good cause. We have this in our own lives, right? It's like you get your cable TV bill. You owe $100 if paid by October 31st. If you pay after that, you owe $103.50. And you look at your calendar and it's you've missed it. You ever had that happen? We have that. I have that happen in my own life. Well, that's a lot, isn't it? If you figure it out on an annual interest rate, it's a lot. Okay? So the main reason my clients don't make their purchase discounts is because they're just, I'm so busy, I just missed it. I'm just so busy. Well, you need to hire, you'd be better off to hire some help and make those discounts. Okay? One last thing I want to point out is, folks, there are people out there who hope you stay financially ignorant. I'm not saying you are now. But they don't even like that I'm going to tell you what I'm going to tell you. They like consumers that are financially stupid. Okay? And they'll send you stuff. You folks getting credit card offers in the mail? I could wallpaper my basement with credit card offers. Now, here's the way they used to sell these credit card offers, is you would get an envelope in the mail, okay, and it would say, new credit card, only 4% interest rate. And then they'd have an asterisk here, and it would say 4% per month. And then down here they'd add a message. We love you. Okay? And they want you to be stupid. They want you to think, hey, a new credit card, I don't know much, but I know this. I know 4% is a pretty low rate. We pay more than that on our mortgage, a lot more. Well, listen, Einstein, it's 4% per month. It's not annual, is it? So what is a 4% per month, roughly speaking? What is that on an annual rate? 48%. There used to be credit card companies and banks and credit unions and other lending authorities that would try to mask what the annual percentage rate was, and that's why they made rules that say you have to have in a certain type of font, a certain size of font, what your APR is, right? Annual percentage rate, because they were trying to deceive. They want you folks to be stupid. They want you to be stupid, and they want you to go buy a big screen TV on their credit card, and the big screen TV costs $600, and before it's all said and done, you gave them $980. Okay? Don't let them take advantage of you. Okay? These credit card companies, they don't love you. I'm going to tell you, they do not love. They say they love you. They do not love you. They want you to stay fat, dumb, and stupid. Okay? Dumb and stupid, same thing, right? Okay. So, word to the wise. All right, let's talk about a few more things in regards to purchasing. Purchase returns and purchase allowances. Okay, these are very similar things, and they look the same with our journal entries, but they're actually different. Okay, here's let's talk about these, purchase returns versus purchase allowances. Okay, let's come off there if we can. Let's say you're going to purchase some tables, okay? And let's say that you purchase 10 of these tables that you're sitting at, and let's say you pay $50 each for them, okay? And you're going to sell them in your retail store for $90. Well, let's say you sell, how many did I say you purchased? 10. Let's say for whatever reason you bought too many. And so you just returned one. There was nothing wrong with it, you just returned it. Now chances are you haven't paid for it by then, so they just knocked off $50 of what you owe them, right? You guys know purchase returns, right? Okay? You buy a sweater from JCPenney, and you take it home, and you show your husband and go, does this look nice on me? And he says, oh. Okay? And you decide you don't like it, so you take it back and get your money, right? There's nothing wrong with it. Okay? That's a purchase return. They just knock off what they owe you. Okay? We'll see how that looks. A purchase allowance is the following. Let's say I purchased 10 of these tables for $50 each. And so I owe them 10 times 50, $500, okay? And let's say that once I unpack them, I notice that one of these has a scratch on it. It's not real big, but maybe a 4 or 5 inch scratch on the top, okay? Well, I call the manufacturer and I say, hey, one of these tables you sold me for $50 has a scratch on it. And they would probably say, well, you can do one of two things. You can send it back to us and we'll knock off $50 of what you owe us. Or if you want, keep the table, we'll knock off $35 of what you owe us, and essentially you'll end up buying that table for $15. Does that make sense? With a purchase allowance, I don't actually return the product to the manufacturer. They just kind of give me an allowance. And I might decide, yeah, I'll keep the table if I could buy it for $15, because I might be able to sell it to a customer and actually make more money on it than a regular table, right? There's people like me who are cheap, who like to buy stuff like that. When I bought our clothes dryer, the clothes dryer was normally, $280 or something like that, but it had a big long scratch on the side. It was still brand new. It just had a scratch. There was nothing wrong with it. It just had a big long scratch. And so they said, you can buy it for half price if you want. And I said, giddy up, baby, right? Because who cares if my clothes dryer has a scratch on it? Do you ever go to your friend's house and say, I want to look at the side of their clothes dryer? Who cares? Okay? So a purchase return, you actually return the good to the manufacturer. Purchase allowance, you keep it and they just knock off some of what you owe us, or what you owe them. Make sense? Let's take a look, see how that looks. Okay, on May 9th, Matrix Inc. purchased $20,000 of merchandise inventory on account. Credit terms are 210 net 30. Okay? Well, that's the journal entry. We debit merchandise inventory, we credit accounts payable. Now, on May the 10th, we returned $500 of defective merchandise to the supplier. We haven't paid yet, so all that happens is we decrease our liability, we debit our accounts payable by $500, and we also decrease or credit merchandise inventory because we don't have it anymore. Does that make sense? Now, Carrie, you asked, is merchandise inventory always a debit balance account? And the answer is yes, it's always a debit balance account. But we know all accounts are debited and credited, right? Going back to this journal entry, when we credit merchandise inventory, since it's a debit balance account, that simply means we're decreasing it, which is what reality is, right? We're returning $500 of merchandise. So how much do we owe them at this point? We owed them $20,000. Then we sent some back and we decreased it by $500. What do we owe them at this point? No? We owed them $20,000. We returned $500. We only owe them $19,500, don't we? And that's if we pay, that's if we don't take advantage of a discount here. Okay? So we pay. Do we pay within the discount period? Yes, we do. So we don't have to give them the full $19,500. We don't have to give them the full $19,500. We only have to give them 98% of the $19,500, which in this case is $19,110. Now, one thing that they want to point out here is that we take the discount based on the $19,500. Don't take it on the $20,000, because that's not what you owe them. You see what I'm saying? Because you sent back $500 worth of those goods. Okay, take it on the $19,500. Cool? Okay, let's talk about, what I want to do now is this. I want you to do, and we're going to take a few minutes to do this, I want you to do Quick Study 5.3 on page 209. On 209, page 209, I want you to do Quick Study 5.3. For you folks at home, you do it as well. We'll come back in a few minutes and we'll go over the answers to Quick Study 5.3. Roll that music. Okay, if you folks at home aren't done, just pause it and you can start us up when you are done. But in that transaction on Quick Study 5.3, on March the 5th, we purchased 500 units of product at $5 per unit. And the terms were 210 and 60. Okay? So, the journal entry on March 5th would be a debit to merchandise inventory for $2,500 or 5 times 500 and a credit to AP. Correct? Now, what happened on March the 7th? We returned 50 defective units. Now, this was a purchase return, and we received full credit. So what's 5 times 50? It's 250. We decrease our accounts payable, and we decrease our merchandise inventory for 250, right? So how much at this point do we owe them? $22.50. Do we pay within the discount period? Yes. So we don't have to give them $22.50. We only have to give them 98% of $22.50, which in this case is cash of $22.05. And of course we credit or decrease the accounts payable for $22.50, and we have fully extinguished that liability. Taken care of. We don't owe them anymore, do we? Now, somebody pointed out something in break that was good. When we say we pay in cash, that doesn't mean I'm taking $100 bills and shoving them in an envelope and sending them. We're writing a check, right? But that's the same thing as paying as cash. It comes out of our checking account. Okay? All right, any questions going back to that? Any questions on this? Quick Study 5.3? Okay, a couple last things that I want to go over that'll just take about a minute is there's also the item we need to cover of transportation costs. Now, there are some times that the seller pays for transportation, and there's sometimes that the buyer pays transportation. And it's important to know. Now, the way that they do this is if it, you know what FOB stands for? Free on board. Free on board. And we're always thinking from the perspective of the merchandiser. So if it is free on board, clear to the destination. It is free on board, clear to the destination. Well, we're the destination, right? That means it's free, clear to here. That's the destination. That means the seller pays for transportation. Now, if it's free on board only up to the point where they ship it, this is where they start to ship it right here. That means that while it's traveling, we're paying for it. The buyer is paying for it. So free on board shipping point, it's only free up to the shipping point, thus the buyer has to pay. If it's free on board to the destination, that means that whole time it's free for us, and the seller pays. Okay? Now the question might come up, who owns those goods while they're being transported? Well, the answer is this. Whoever is paying for the transportation owns the goods while they're being transported. So if you see a train full of stuff moving along or a truck full of stuff moving on the highway and you're going, I wonder who owns that? All I would say is, well, tell me, is the buyer or the seller paying for the transportation? If the buyer's paying for that transportation, then as it's moving on the road, the buyer has it in their inventory, on their books. If the seller is paying for it, then they own it. Does that make sense?
If the buyer's paying for the transportation and something happens,
okay, then you get into insurance.
okay.
There's usually insurance on it. Okay. Usually there's some sort of insurance with the transportation company. But whoever owns the goods is whoever's paying for the goods while they're being transported. Now, lastly, let's look at an example. On May the 12th, Jason Inc. purchased $8,000 of merchandise inventory for cash, and they also paid $100 for transportation costs. I want you to recognize that we debit merchandise inventory for that full $8,100, which includes that $100 transportation cost. We don't have a separate expense account called transportation expense. We want to capture those transportation costs in merchandise inventory. So we debit merchandise inventory for that. Does that make sense? Any costs that were necessary to get that merchandise inventory become part of merchandise inventory. All right? Okay, that is it. I'm only giving you one homework question to do, but I want to make sure you do it. So do exercise 5.1 for next time. Do exercise 5.1. All right, see you guys.